So, what if I told you that a company, one that's reporting record-breaking profits, could actually be on the verge of total collapse? It sounds crazy, right? But it happens. Today, we're diving into financial ratio analysis. Think of it as the diagnostic tool that lets you see the real story hidden inside the numbers. And look, mastering this, it's not just a finance thing, it's the skill that separates a truly great leader from a good one. Okay, I want you to imagine you're the CEO. That quarterly report hits your desk and the headline is just glowing, record profits. The board's happy, the market's happy, everyone's happy. But here's the question that should really keep you up at night. Is that single number telling you the whole story? Because relying on profit alone is like flying a plane with only an altitude meter. Sure, you know you're high up, but you have no idea if you're about to fly straight into a mountain. Let's consider a scenario. You've got Company A posting absolutely record-breaking profits, the darling of its industry. And then there's Company B, just showing modest, steady growth, nothing flashy. Now, if you had to bet on one, if you had to invest your own money, or maybe your career, the obvious choice is Company A, isn't it? But what if I told you one of them is so dangerously overleveraged and it's burning through cash so fast that it might not even make payroll next quarter? Whoa. Suddenly, that glowing profit figure, it starts to look like a mirage. And this is exactly why we need to look deeper, to diagnose the true health of a business beyond those attractive, but often very misleading headlines. To get that deeper understanding, we need the right set of tools. I want you to think of it like a doctor's medical kit, but for your business. We're not just going to take its temperature with a profit number. No, we're performing a full workup. We're checking its heart rate, its blood pressure, its respiratory efficiency. This is the leader's diagnostic toolkit, and it's what transforms you from just a scorekeeper into a real strategist. At the core of this toolkit is ratio analysis. Now pay close attention to the key phrase here. It's the systematic use of ratios. This isn't about, random number crunching or trying to find one magic number. It's a structured, methodical process that turns that raw data from financial statements into a clear diagnosis of a company's strengths, its weaknesses, and, maybe most importantly, its future potential. And here are the tools right inside that kit. Each category of ratio answers a really critical question. You've got your liquidity ratios. They ask, hey, can we pay our bills next month? Then there are solvency ratios, which ask, can we survive in the long run? Activity ratios ask, how efficiently are we actually using our assets? And finally, profitability ratios ask, are we generating enough return from our sales? You see, together they create this complete multidimensional picture of business health. Okay, this part is so crucial. A ratio on its own is completely meaningless. If I say a company has an inventory turnover of 6, is that good or bad? Well, if you're selling fresh groceries, that's terrible. If you're selling commercial aircraft, it's absolutely phenomenal. The power comes from context and comparison. Are we getting better over last year? That's trend analysis. Are we keeping up with our biggest competitor? That's inter-firm comparison. And how do we stack up against the whole industry? Well, that's the benchmark that tells you if you're truly best in class. All right, so let's start our checkup with the most immediate, pressing concern, the financial vitals. I want you to think of this as the business equivalent of checking for a pulse in the emergency room. It answers the most fundamental question of all, long before we can even start thinking about long-term strategy. And that question is simply this: can we pay our immediate bills? This is all about liquidity, your ability to meet those short-term obligations. A company can be wildly profitable on paper, but go bankrupt simply because it doesn't have the cash on hand to pay its suppliers or its employees. Always remember this: profit is an opinion, but cash is a fact. Now, our two main tools for this are the current ratio and the quick ratio. The current ratio is pretty straightforward. It's your current assets divided by your current liabilities. A ratio of 2-to-1 is generally seen as healthy. But the quick ratio, which is also known as the acid test, well, that gives us a much more conservative and often more realistic view. It subtracts inventory from your assets, basically asking the really tough question: if we couldn't sell a single thing from our warehouse tomorrow, could we still pay our bills? So let's go back to our two companies. Company A, the one with the record profits, well, it might also have massive short-term loans, giving it a dangerously low current ratio, maybe 0.8. Yikes. But Company B, the one with modest profits, has super tight control over its liabilities. It could have a really strong current ratio of 2.5. All of a sudden, Company B is looking like the far healthier, more stable business, isn't it? All despite that lower profit headline. Okay, the pulse is steady. We know we can survive the short term. So now let's zoom out and look at long-term stability and structure. The key question we're asking here is all about leverage. How much of our company is financed by debt, and what level of risk does that really create for our future? To measure this, we use the debt-to-equity ratio, which compares what you owe to what you own. Now, this ratio isn't about good or bad. It's a direct reflection of your business strategy. A high ratio is like a rocket ship. You're using debt as fuel for aggressive growth, which can amplify returns for your shareholders. But if things go wrong, that same fuel can cause a catastrophic explosion. A low ratio, on the other hand, is like a fortress. You're safer, more resilient to downturns, but you might be playing it a little too safe and missing out on some major growth opportunities. Next up in our health check is operational fitness. So we know the company can survive, but how well is it actually running? This is where finance connects directly to operations management. Are we a lean, mean, efficient machine, or are we just wasting capital and resources? This brings us to a category called activity ratios, and they all pretty much center around one critical question of efficiency and speed. How quickly are we converting our assets, things like inventory, machinery, real estate, into actual revenue? Because assets that just sit there are a major drag on performance. And one of the most powerful activity ratios you can look at is inventory turnover. I mean, think about it. Every single product sitting in a warehouse is basically cash that's been tied up, cash that can't be used for anything else. For any business that holds stock, whether it's a retailer like Amazon or a manufacturer like Boeing, this ratio is a vital sign of operational health. It tells you how quickly you're turning that stock back into cash. A high turnover ratio is a sign of incredible efficiency. Think of a company like Zara, which turns over its inventory at lightning speed. This allows it to respond to fashion trends almost instantly. A low ratio, however, is a huge red flag. It suggests you're overstocked, your sales strategy is failing, or your products are becoming obsolete. But then again, a luxury jeweler will have a very low turnover, but an astronomical profit margin on each sale. This is a perfect example of how ratios, when you compare them to industry norms, reveal the very core of a company's business model. So, we've checked the vitals, we've looked at stability, and we've measured fitness. But the true skill of a leader, the skill they teach in every top MBA program, isn't just about calculating these numbers. It's about synthesizing them, putting them all together to understand the complete, nuanced story they are telling. This is probably the most important takeaway of all. A single test doesn't give a diagnosis. The full panel of tests does. For example, high debt might seem risky on its own, but if it's coupled with really strong and stable cash flow ratios that show you can easily cover the interest payments, well, that might be a very smart strategic move. Or a company could have fantastic profit margins, but if its day sales outstanding ratio is climbing, it means customers aren't paying their bills on time. That paper profit could turn into a real cash crisis. You have to connect the dots. So here it is, all boiled down into 5 clear, actionable steps. 1. Gather your data. The income statement, balance sheet, cash flow statement. 2. Calculate the key ratios from your diagnostic toolkit. 3. And this is crucial. Compare those numbers to historical trends and industry benchmarks to give them meaning. 4. Synthesize all those data points into a coherent diagnosis of the business's health. And finally, number 5. Make a strategic decision. This is the prescription to improve the health of your business. So the next time you see a financial report, don't just look at the bottom line. Please remember that these numbers are telling a story. They aren't just for accountants, they are a narrative for leaders. And that leaves us with one final question for you. What is the hidden story in your financials? And you now have the tools to read it?